So I was a managing director with Merrill Lynch when I actually kind of gave up everything and started this.
What was that moment or that day or that week where you decided that no, I need to do this on my own now?
Days and days, months and months, I was just tired. I was extremely tired. My body couldn't take it taking that high pressure job just because it is giving you high pressured money.
What do you think are the most common myths or sort of misconceptions people have about AIFs?
It was a good decision in hindsight because the popularity of AIF has actually multiplied. Fortunate part that we were very early. The unfortunate part is that we started an open-ended fund. Upside of that open-ended fund, as we realize now, that you can get in and get out anytime. That is an upside. The downside is the same.
On a personal portfolio level, what sort of asset allocation do you follow?
My investments are heavily skewed towards equity. Close to Rakesh Jindalwala, I was actually close to him. But a lot of things which he did, one has to realize that it could not do it as any human. One could not do what he did.
So what's your idea about taking a cash call? Is it an active choice? Is it just waiting for the next deployment?
Currently, cash is around 10%. We just want to be a niche boutique kind of a firm. The longer you stay, the better would be the prospects of our fund. I understand best. I want to be a fund which can grow organically. We are transparent with investors. Very simplistic way of explaining AIF, mutual fund, PMS.
Hi, I'm Shrey Mehta. I'm a financial planner. I've been helping people invest their money for almost 10 years now. While finance can be complicated, the people behind the scenes don't need to be. These conversations are a simple attempt to get to know better the people who manage your money. Today I'm talking to Arun Subrahmanyam. Arun has over 35 years of experience in equity research. He was Managing Director of Research at Bank of America Merrill Lynch for over 11 years before founding Ampersand, a boutique firm that runs an award-winning alternate investment fund. So let's dive right in.
I started this journey in Ampersand. Before actually going to the past, I started Ampersand. I founded Ampersand in 2015, 2015. 10 years ago. 10 years ago. But within that, the first 2 years, we were doing investment advisory because we really did not know what kind of vehicle to use. And we didn't have people. I mean, nobody. I just had one more person who had joined me at that point in time, who helped me set up the office. And then he said, we'll try and assemble a team and try and get like-minded people to start a fund. But before starting that, we said, okay, let us start do advisory. That is something which people who knew me and who trusted my instincts or my skills of investing in stocks. We will try and target them. And it will be very informal. But of course, we did it in a very structured fashion. We gave exams and passed and things like that, which SEBI requires you to do. So we got an investment advisory license and we started the fund, which went on for about 18 months. We did incredibly well there. But then we realized that, this is not the right way to do it because it's obviously very haphazard. It doesn't really have a format or nobody really values investment advisory unless you have a vehicle, a structured vehicle which can track your performance. PMS was the most obvious vehicle because a lot of people were using it. But we somehow, when we actually met a lot of people and we realized that PMS is something which is going to be extremely difficult for people like us to handle. And I'm saying us here because by that time we had actually got people who joined me. I had a person who joined me who was working with me earlier. He joined me, a guy by the name of what's his name before? What is his name also? Rahul Singh. A guy by the name of Rahul Singh. He joined us in 2015 and he stayed with us till 2018. Then he left us, and I'll tell you why he left us also. But anyway, before that, we got the second person called Sanjay Mehta, who had worked with me in Merrill Lynch. So basically, most of the people who have joined us or joined me have actually have worked with me. I've worked with them in the past. We have another person in research who's actually worked with me in Merrill Lynch. Then we have a couple of juniors who actually work with him. So we have a 3-member research team. We have Sanjay and me, 5 people. Rahul, like I said, left us and joined Tata Mutual. He got a offer at that point in time to become a CIO of Tata Mutual. So he went there. Not that he, as a professional decision, I think it's probably, it would have been probably better if he had stayed here. But the reason he left was, there was this big panic in 2018 when there was a credit crisis and markets tanked, and he didn't really want to, take that chance. And he had a young daughter and young son and a daughter. So he said, I'd rather go back to a 9 to 5 job than this. So that's okay. That's less spoken about him, the better. But we parted amicably. But so now we have a 5-member team, which is basically looking at the front office. Then we have Tushar, who obviously you know. Then we have a couple of people in the back office who actually look after all the documentation, and the post documentation. Operational aspects. Yeah, so that's a very, very small team. So 5 plus 1 6 plus 2 8, and of course the general peons and all that. Anyway, so that's basically us. We started in 2017. We applied for a license for the AIF. Okay, before that, why not a PMS? Why a PAF?
Yes, I also want to know that.
Yeah. So the PMS, the thing about PMS is whenever I actually met people or we met people, they used to say, they used to keep asking us what stocks to buy or what stocks, tell us what stocks to buy. So we said, okay, I mean, we'll give you ideas, but I mean, you give us money and we'll buy the stocks. So they found it much easier to take ideas from us and invest themselves, which is what most people do. See, the PMS success has largely been because it's a very transparent thing. You exactly know what the fund manager is doing, investment manager is doing on a daily basis. Demat is in your account. You know what stocks are coming into your account, what stocks are getting out of your account. So if you're given a PMS investment manager 25 lakh rupees and he's invested in, let's say, 10 stocks, you can then decide with your own funds
replicate that portfolio.
So that is something which we didn't want. We were very uncomfortable because then people will ask you, why did you buy this? Why did you not buy? Things like that. And they obviously take leverage positions and things like that. So which worried us. The AIF was a better structure because it was more like a mutual fund. It's a portfolio, which is a pooled account. And it's something the discretion about investing or not to invest is completely dependent on the investment manager. The portfolio is not revealed daily. The demat is in the account of the trust, which manages the fund, and that is the reason why we thought of going for the AIF. And it was a good decision in hindsight because the popularity of AIF has actually multiplied in the last couple of years. We were very, very early. The unfortunate part, the fortunate part that we were very early. The unfortunate part is that we started an open-ended fund. And I'm saying unfortunate part because we didn't know how to start a closed-ended fund. The reason is that to start a closed-ended fund, people need to trust their money with you for 5 years or 7 years. And at that point in time, when we were just starting off, there were very few people who would trust us for 5 years or 7 years without a track record. A track record of doing investment in Brazil, not a track record. So that is the reason we had to go for an open-ended fund. And the upside of that open-ended fund, as we realize now, that you can get in and get out anytime. That is an upside. The downside is the same. You can get in and get in at any time. So when COVID came, people got out. So our 140 crore fund, we had started with 40 crores. In 3 years, we went to 140. That 140 crore fund went to 80 crores because people redeemed in March. And of course, the fund also did badly in March because everybody did badly in March. So that's the downside. And that set us back by about a year and a half. So 20, we lost a lot of investors. But by the time we came to 21, 22, the markets recovered, but we did get a big set of new investors. But so the next couple of years, we were just consolidating and building from the original capital. It is then that we realized that we have finished 5 years of managing the fund. We have a track record. We have done okay. We didn't do incredibly well. Of course, whatever our greatness was visible because the post-COVID, everybody did well. So we also did well. But there's nothing great about it, But the fact is that in 17 and 18, when people are not doing well, we were doing quite well. And that people lost, that whole thing got lost out because post-COVID is what everybody said. I mean, तुमने COVID से कितना multiply कर दिया पैसा, but people forget you first multiply, before you multiplied your money half, that it came down to a fraction. Even our money came down, but it came down not because we did very bad. We did very badly post-COVID, during COVID, but we lost a lot of people to redeem. So that's what happened. Anyway, so that's the history of the fund, the first 5 years. The sixth year, we said we should do something about this. So we reached out to people and showcased our fund, and this is what we do, and this is what our return has been. And we then looked out and scouted out for people who can market our fund better. And that's why Tushar came in. It took us about 6 months to get Tushar, but 22 we started and Tushar came in 23. And thereafter, immediately, we set the ball rolling, and he must have told you his journey and what he's done and how many people, distributors we're going to panel with and things like that. Of course, that's a long process, and we don't want to go through that process of paneling with the Kotaks or the IIFs and all that. We don't have that kind of, I won't say ambition, we don't have that kind of bandwidth to manage a 10,000 crore fund. We just want to be a niche boutique kind of a firm which will manage, let's say, about 2,500, 3,000 crore, about up to that. Right now, we're very small. We're 850 crore. With our kind of performance, with a 20% CAGR, post fees, post taxes, since inception, people have gone to 4,000, 5,000 crores. Everybody is going to 4,500 crores. We are only at 850 crores. So that's what it is. Now, what is our investment philosophy? Our investment philosophy to invest in the BSE 500 or the NSE 500 stocks, the top 500 stocks. So we don't invest in micro caps. We don't invest outside the BSE, the NSE, in the sense we don't invest in small exchange, small and the SME exchange. We don't invest in. We don't invest in unlisted equities. Because that is a separate category for investing. That is for category 2 and category 1 investors. We are a category 3 fund. Of course, there is a provision to invest up to a certain percentage of your fund in unlisted equities. But we chose not to do that because that requires a different kind of mindset. And then about giving or declaring the NAV based on investing in certain unlisted stocks and listed stocks, that becomes a bit of a challenge. So we decided that we will do only listed stocks. And now the question was, how do we differentiate ourselves from the others? Because everybody is doing listed stocks, everybody is trying to do something else. Somebody is trying to do derivatives, somebody is doing, like I said, unlisted, somebody is doing, all kinds of things. How do we differentiate ourselves? So the way we differentiate ourselves is we have the kind of companies we choose. First of all, they are completely bottom up. So we invest in anything under the sun as long as they are capable of generating, in our opinion, a return of about 25% CAGR over a 3-year period, which essentially means you can double. Any investor who gets in today can double his money in 3 years effectively. Okay, I'm not saying that that's my guarantee, but that's what we try to do. And the only way we can do it is to invest in companies which can deliver that kind of growth. So that can be profit growth, it can be sales growth, it can be a company which can sustainably grow its business over a long term. And the long term for us starts at 3 years. Of course, after that 3, 5, 7 years, the longer you stay, the better will be the prospects of our fund. And that's what has happened. I mean, initially we started slow, but as we picked up, our returns have actually started to accelerate. But for the last 3 months, of course, we'll get to that a little later. But that is a basic philosophy. So any company we invest in, the whole expectation or hope is that this company will generate can be able to double its profits over a 3-year period. It will not happen for every company. Some companies may grow faster, some companies may grow slower, and it's a combination of that on a blended basis is what we are expecting to achieve. And then, of course, there'll be some mistakes. So somewhere you may not achieve that kind of return. You are expecting 25, you'll achieve 23, 22. It is also possible. But I think today, every investor, after paying taxes, after paying fees, he is very happy with a 20% plus or thereabout return over a sustainable basis. That is a great thing. You're effectively beating inflation. You're the best asset class. Within the best asset class, you're actually getting superior returns. So that is essentially what Ampersand is. Now, how many funds have been able to do this? A lot of people have been able to replicate something what I am saying. But except that when you look at the track record of a lot of companies, when I say company, sorry, funds. What they have smartly done is they have broken out from handling one scheme to doing two, three, four, multiple schemes. That, of course, helps them generate a lot of AUM. That's one. Some people have been staying, have launched closed-ended funds originally. They escaped COVID, so they managed to generate healthy
Great
returns.
returns. Yeah.
They managed to return money and get more money. So a lot of people have done smart things which we have not been able to do so far. And I don't want to say that I don't want to get smart overnight. I don't want to do that because I want to stick to what I understand best. I want to be a fund which can grow organically without all this jing bang of trying to do too many things. Do something very simple. As long as the investor is, we are transparent with the investors, the kind of companies we invest in are completely fundamental research based. Or in fact, I forgot to tell you, the 5 people whom we have, of which 4 people are hardcore research. Like I have done about 23 years of research. My colleague Sanjay has done 16 years of research. The other colleague has done about 8 years of research. Research, I mean equity research. We're working with a broker and then most of us work with foreign firms, but we also work with local firms. One of my colleagues worked with First Global for a couple of years, and then he worked with foreign firms. I worked with a local firm called SSKI. Because I worked with that, and then I worked with Merrill Lynch, and I worked in Singapore for some time. So I was a managing director with Merrill Lynch when I actually kind of gave up everything and started this. So that's basically the background of myself and my fund and where we stand as we stand today. So like I said, I've taken 10-15 minutes, but I've tried to cover everything I could, as much as I could.
Yeah, of course. No, thank you so much for that. You covered a lot of things that I, of course, wanted to ask you. But let me just get into a couple of more details, just taking forward from what you shared. So let's focus on the fund first. So your investable universe is restricted to the 500, or you're going to 1,000 and 2,000 also, as long as they're listed?
So, okay. The latter. I'm okay with investing in the first the 501 to 750 or 701 to 1,000 also. But the problem is that the deeper you go down, you see ultimately say I have let's say I'm a fund of 1,000 crores. I'm just giving an example,
Yeah.
and I invest in 25-30 stocks.
Yeah.
If I keep going down, I'll not invest in 25-30. I'll have to invest in 100 stocks to start with. Because those companies, market cap of 100 crores, 200 crores, market cap, availability is very, very difficult. So essentially to invest in companies outside the BSE 500 or the NSE 500, you basically have to look for new vehicles.
Okay.
It has to be something as micro cap fund or something like that. So, and it's not that we cannot do it. We in our fund currently, we hold 2 small caps. And I'm saying particularly small caps because today people think that everything, today the SEBI classification, not the SEBI classification, the AMFI classification says up to 27,000 crores is small cap, 27,000 crores. Now, 5 years ago, 27,000 crores is a mid cap. 5,000 crores used to be a small cap.
Okay.
So today, that micro cap has become 5,000 crore or something else. So we don't hold any micro caps in our portfolio.
Okay.
But 5 years ago, we held, let's say, probably a small cap or a micro cap, I don't know what you call it, which have now become mid caps.
Yep.
So that's what essentially is. So as long as, we can invest in a micro cap which becomes a small cap or a small cap which becomes a micro cap, in our opinion, it will do it. But if a micro cap is going to remain a micro cap because by virtue of them, nobody understanding the business or nobody knowing how to buy or sell the stock and free float availability being very scarce, you can manipulate the stock, we will not invest in a company. We invest in companies where the growth is sustainable. The company's growth is a sustainable growth. And if you look at India, the small cap universe in the last 20 years, forget post-COVID, last 20 years, has typically been in chemical companies, iron ore companies, all kind of agrochemical, fertilizer, paper, those kind of companies, which essentially have done nothing to grow their business. Very few have broken out and become very, very large. And that is the reason why small cap as a universe is great to invest. As long as you think that those companies are going to have a big future, like a TVS or a Eicher Motor or something, these companies have a great future. So they no longer they were all small cap companies. Though one of them is part of the Nifty and one of them is part of the. So those are the kind of companies we'll want to identify and invest in.
Okay.
So that's basically what the philosophy of Ampersand is.
Okay. So right now, what would be the allocation between large, mid, and small currently?
It's 35% large, 30% mid, and 25% small. Now this changes. This changes. Last year, a year ago, we were 35% small, the 30% mid, and 25% large. Because that is because the large caps did not do well, small caps did well. So the percentages will change.
Yeah.
May not be as varied as moving by 10 percentage points in a year, because last year small caps went up 50% and 40%, and large caps went up just 8 or 9%.
Yeah.
That's where the variation came. But if you look at us over a 7-year period and look at us today, you will find the percentages will be broadly similar. I said 35, 25, 30. It could very well be 28, 32.
Yeah.
So it could be something very similar.
So you have sort of set sort of like a skeleton of you want to be 1/3 in each of them.
Yeah, I don't want to be, but it turns out to be that. That's all I'm saying. It just happens that it becomes that. I don't want, for example, if I put 30%, I'm just giving you some. That doesn't happen that way. If I put 30% in small companies, then I don't want to go to 40, because I know if I keep on investing in such small companies, my risk of the fund increases a lot. So I just want to balance it out by investing in certain, more liquid names, or maybe, like for example, ICICI Bank, we invested in 2017. We still hold it. Now it's a large cap, but it's delivered. It has delivered 5x returns over a 7-year period. Now 5x over a 7-year period is great, but when people look at COVID and they said we have generated 5x in 1 year, it's not great. But it is better to be in ICICI over a 7-year period than to keep trying to look for five baggers in a year or 2 years. It doesn't happen that way, right? If you keep looking for that, then you'll have a January, February coming around the corner.
Correct. So do you hold any cash currently?
Currently, cash is around 10%. 10% is the cash. That's why if you add the three, 25, 30, and 20, 35, 20, and 25, it comes to about 90, and then 10% is cash.
So what's your idea about taking a cash call? Is it an active choice? Is it just waiting for the next deployment?
Yeah. So we don't take active, huge cash calls. First of all, multi-cap funds, that's what we are. If you look at across categories, multi-cap funds hold the least cash, because it's a well diversified, balanced fund. So by actually investing 35-40% in large companies, you effectively have cash. Some portion of it is cash, because they don't fall much and they don't go up much. So that is the reason why we don't take more than 10% cash. We don't take cash calls more than 10%. Now people will ask us, no, that is the reason why you did badly in January and February, because you're not holding so much cash. But people who held cash, 20% cash, 25% cash, also did badly. And we did not lose too badly in January and February because of small caps. We did badly because of large caps. It so happened that the mix of our companies, kind of companies we invested, the large caps did worse than our small caps, which it so happened. I mean, just our fate or luck. Like Zomato we had is a large company which fell from 290 to 220. It happened in January, and we had about 5-6% of it. So that happened. Polycab was 7,500, it came down to 5-6,000, and it was a 20-25% we lost in about 8 out of the top 10 holdings in January. 25% we lost each of the stocks. The only stocks which did well was ICICI, not did well, as it did well, it did not go up. It fell less. It fell by 2%, and something else fell by maybe 4% or 5%. So cash calls is something which we don't take very aggressively. Even today, a lot of people, when investor came to me and said, I'm exploring a lot of funds, some people are holding a lot of cash. And of course, he must have gone and invested in those funds only. And then he must have looked at my performance over the last 3 months and said, those people have done better than you, so I'll invest with them. The fact of the matter is that in times like, if you look at on the recovery process, we typically recover faster, number one. And when markets fall, we typically fall less. Now, that whole paradigm, that whole equation got knocked off in January when we fell. We did very badly. But that is just one of those one-offs. I mean, I consider a one-off. an investor who doesn't know me may say that I'll wait for 3 months and see what these guys do. But that's okay. But the fact is that if you look at our portfolio of 840 AUM of 850 crores, and the last 140 clients, we have 250 folios, approximately 250 folios. 250 folios had only 30 redemptions over a 7.5 year period. That means active were 220. The 30 redemptions which happened, about 30 out of 200 is a very, very small proportion, right? In terms of redemptions. So we've not had big redemptions. Most of the redemptions, like I told you, happened during, some of it happened in 18, and a lot of it happened between 20 and between the 20, the COVID year of 20.
Yeah.
So other than that, we've not had redemptions. People don't redeem fund from us because, because we are not good. First of all, our fund is such that I have invested, my colleagues have invested, our families are dependent on this fund. We don't have any other vocation. So they know that people who invest with us know that we are not going to take the money away anyway. We don't have anything else to do in life. So.
Okay, great. So, if just taking it forward from that, since you mentioned that you have invested in significant family money, etc. So, on a personal portfolio level, what sort of asset allocation do you follow?
Personally,
How much equity allocation?
Okay. So see, so I have my investments are heavily skewed towards equities. Okay, my personal investments also are skewed towards equities, except that my personal investments are not actively managed. I don't look at them. They're investments which are lying there for 8 years, 10 years, and all that. So I don't look at them. I don't actively manage that fund, that personal investment. But that I don't know what that number will be, but it will be a number which will be quite substantial. But I don't really look at it. Then I have some funds which are locked in US equities. That is because I was working for a US firm and I used to get those options, in which I sold and I invest in US equities. Those also I just let it be because frankly I'm not going to do anything with that money. If I bring it back, I have to pay tax. Let it be there. So I don't care. So I get some currency appreciation and things like that. And those companies are, so I'm not bothered. I've invested in some Google and Alphabet and Amazon and all that. So that's what. Then, of course, most people love to invest in property. I don't. Just pure Indian habit, I think I have one property where I stay in and another rented property. So properties which I own. Other than that, there is nothing really much. There are some precious metals and all, which typically housewives like to indulge in. Other than that, there's nothing really else. So whatever I actually get as savings or whatever I get from my partnership firm here as my contribution, I'm allowed to withdraw. Most of that I reinvest back into the fund itself. I don't, like I said, I don't invest personally. So most of that is in the fund. And that's the reason why my the fund, I think 25% or thereabouts would be my own fund in my own contribution in the fund.
Do you believe in taking hedging calls via puts or something?
I can't take. I can't get into any kind of derivatives. I can't do anything in derivatives. I cannot do, because then I'll have a different tax structure. Right now, I have a simple tax structure, long only fund, which is 10% for short, 12.5% for long term, and 20% for short term. That is all I have. So I can't do anything else. If anything I do outside of the long only philosophy, I have to do it through a separate scheme.
Okay, great. Any plans of launching a separate scheme?
No, like I said, I'm subscale in a multi-cap fund. Most multi-cap funds are 3,000, 4,000 crores at the least. I'm 850 crores. And if you exclude the money which is mine and people who I know, my fund size is less than 300 crores.
Okay. All right. So then that's the core focus is going to remain on this fund and no other structure, right?
Nothing. No.
Yeah.
I'm open to it. But like I said, I don't need to spend so much energy on something else when this itself is, yeah.
All right. So when you decided, you told me that 7 years ago when you started, the reasons why you didn't choose the PMS structure, you followed the AIF structure. Now, with hindsight available, do you think that was the right decision? Would you want to handle PMS?
Yeah. I'm telling you, it's a right decision. Except that the PM, the AIF is still not well understood. See, I will tell you a very simplistic way of explaining AIF, mutual fund, PMS. Since most people start with the PMS or a mutual fund. Mutual fund, everybody understands. You invest in a mutual fund, you get into a pooled account. Once you invest in any mutual fund, you'll get units which are allotted to you, and you become a holder of each of the stocks the mutual fund holds, which is exactly the case with us.
Yeah.
The difference between mutual fund and us is that the mutual fund, they have the advantage of a tax pass through, so they don't pay taxes. They don't have to pay taxes. When you redeem the fund, when you redeem the units, you have to then take the money and then pay taxes. In our case, every time I have to pay taxes. You don't have to pay taxes. When you redeem the fund, you don't have to pay taxes, so you are not bothered about taxes. The PMS, on the other hand, has a luxury of not paying taxes, the PMS itself. And the investor has to keep paying taxes. So while the PMS, we keep telling you that this is my return, I made 5% this month, I made 20% last month or whatever, or last year, he may have churned his portfolio 3 times and generated less than 2% return. But because the tax is paid by the investor, so what AIFs gives you is essentially post-tax return.
Yeah.
PMS gives you post-fees return. That's it. It is never post-tax. I'm not saying that well-managed PMSs can't do well. They will do the well-managed PMSs. Any PMS which is managed well, they can generate returns. They can generate 20-25% kind of returns annually, but that will be pre-tax. They can generate, or they can do even better. Like Stallion has done better, and all that they can do. Even Stallion does well. He will buy a polycap, but he will buy and sell polycap 5 times a year. I'm holding polycap since 2019. I have sold once or twice, but over a 6-year period, I've done that once or twice because I have to keep paying taxes whenever I sell. When I say the fund. So the investor gets impacted by that on an NAV, which you don't realize because anyway it's lying as a part of the fund. But when you hold it, when you invest the PMS, you have to pay the tax every quarter, every year.
Yeah. Oh, correct. So that is actually a big advantage that when we speak to a couple of HNIs, ultra HNIs, that they are preferring the AIF structure because of this, that if they have
Absolutely.
4 or 5 PMSs, then the tax calculation is just too big of a hassle for them.
Exactly. Absolutely. So that's what it is.
So what would you want? So let's say that you are talking to a current or a future investor in your fund. What would you want them to expect, and what would you want their behavior to be like? Ideally, what should they know before investing in Ampersand?
See, okay, I don't know what I should, I could be very idealistic and want a lot, but that will never happen. But I'll tell you, people who have invested with us, they invest with us because we are very transparent and genuine. I'm not saying that's a bad thing, but sometimes this business of ours, it does not necessarily pay. That is because we don't really shout and talk a lot or talk up our fund and do these things. We are very transparent. We tell people everything. When we do badly or when we think we're going to do badly, we tell people that this is the thing, this is the problem. We need to do something about our fund. We are holding too much. For example, last month, I'm talking about the April and May. We did not do well. We've done well, but we were not happy because we are holding some stocks which are very dependent on the seasonality of the summer, or the heat wave being there or not being there, or monsoons coming on time and things like that. And that has actually impacted 10% of our portfolio very badly. The 3 stocks which we hold, for example, Blue Star is our stock which we've been holding for 3 years. Blue Star is down about 40% in the last April and May. Because summer has not been so strong in the south, and Blue Star sells more in the south. So that is the reason Blue Star has done badly. Varun Beverages, which sells Pepsi franchise, it's also not done well. As a stock is not done well, we are holding that. So these things have happened to us, but that's what it is. But the point is that because that is happening to us, we will not go and sell Blue Star and say, okay, let me go and buy something else. If I invested in Blue Star, I have taken a 3 or 5 year view on the company's business. It is not because I've taken a view on what the meteorological department is going to say. Things like that.
Yeah. So taking that forward, so when you're getting into a name stock, you are looking at a 3-year, 5-year view?
Yes. It's not that we don't invest for 2 years or less than 2 years. We've done that too. But that is because A, the stocks have done very well, more than our expectations, or B, where stocks have not done well, and we've had to revisit our investment thesis and see whether this is the right thing. Or C, because of certain extraneous some circumstances where we need to change our investment strategy. So these are the reasons. Otherwise, typically, when you invest in equities, it is a firm belief that you invest for at least 3 years.
Okay.
I
And
don't want to
typically,
say 5 years and 10 years and all that. Yeah, sorry.
typically your holding period has been how long over the
Yeah.
inception of?
So it all depends. There are stocks which have held for less than a year for the reasons I explained to you.
Yeah.
But typically it will be 18 months to 2 years. 18 months to 2 years is typical. It will not be less than that. I mean, like I said, there are stocks which have held for 3 and 5 and 7 years also. But when you take a blended number, it will be at least 2 years. It will be close to 2 years.
Great. You have a lock-in in your fund for a year, right?
Yeah, that is basically for tax considerations. I mean, because 1 year is long term, short term. Long term we pay 12.5 and short term we pay 20. So that is the reason why we have that. It's not something which, I mean, I can remove it also, but then if I do it for every investor, it will be the fund with the tax department will think that I'm taking money and it's getting churned a lot more. That's the reason why we have to do that.
Okay. All right. Great. So, as you said, you're bottom-up stock because you're focusing on 25 to 30 stocks, right? Did I get that correct? So,
Right.
how did you reach that as the sweet spot where you want to be in 25 to 35 names?
It's not that 25 to 30 names came out of the blue. When we were a 140 crore fund, we were not investing in 25, 30. We were investing in only 10 or 12. As the fund size grew, we realized that this is the kind of mix we need. So 25 to 30 is something which kind of fitted the general narrative of how we actually wanted to divide our fund between large, small, and mid, and what kind of allocation we wanted to give, and that's how we came at the 25-30. Tomorrow, if you're a 2,000 crore fund, we probably we may go to 30-35. But we're not going to become a mutual fund where every fund is investing in 100 stocks. We're not going to do that. At the same time, we don't want to get into a very concentrated business of having less than 20 stocks. SEBI norms have the rules that we cannot invest in. We have to invest less than 10% in every stock. Less than 10. 10 is the maximum. So 10. I have to start with 10. I can't be below 10. So 10, I can go to 20, 25, 30, somewhere there. So it's not a number which I came through. I had decided, and it is at times we even go to 31, for example. But it is not that it is done out of a choice. Somehow we are not able to sell certain stock, but we've got a better idea. We invest in that, and it will take time to sell that stock. So we try and manage the 25 and 30 all the time.
Okay, great. So the SEBI mandate is, of course, a limit of 10% for a stock. Do you have internal mandates? Do you go up to 10% or you cap yourself lower at say 8% or 6%?
I have to cap myself lower. I don't try and cross 6.5%, because by the whole logic of having 25% CAGR in our returns, so you will go to that. Especially if you're not getting inflows. If you're getting inflows, then you obviously can keep limiting it.
Yeah. Any particular sectors or themes that you focus on more than the others, or is it purely bottom up? You're happy to buy anything out there?
So, anything we are not ready to be. See, we don't typically invest in commodities. We don't invest in PSUs. We don't invest in capital intensive businesses. I mean, we do, but it's selective. So leveraged companies we don't invest in. But as a consequence, you would say that why should we invest in banks? We do invest in banks, but not wholeheartedly. We invest because we need to have some investment there. So there are some do's and don'ts, but we are flexible. And in terms of spaces we like, because we understand it better and we have done better over a period of time. Consumption is something which we have done well. Pharma, we have done well. IT has been off and on. We have done well sometimes, we have not done well sometimes. And financials, we have been okay. I mean, we don't understand that this financials, banks and NBFC space as well as specialist would do. So we have been okay, but we have done okay. We've not done remarkably well, but pretty okay. So those are larger spaces. IT, financials, FMCG, and all these have been the large spaces.
What do you think are the most common myths or sort of misconceptions people have about AIFs?
Yes.
Yeah.
So first of all, I think people don't like dealing with this whole concept of a pooled account because they think it's a kind of a model portfolio. Everybody has the same portfolio, so there is no kind of people want to get more excitement in terms of
Yeah.
trying to get into more opportunities of investing.
They want that SMS of X stock has been bought in your demat account.
Yeah. That's something which is the one which people. But the way it works is very simple for us, at least. We don't keep a constant portfolio for every investor who comes at any point in time. I mean, we do, like I said, we don't churn very much, but 20% of our portfolio does undergo a change over a 1 year period. That's why I said, although I would like to hold stock for 3 years, and we do hold a lot of stock for 3 years, but the average investment holding would probably be 18 months to 24 months. It's not that it is 3. I don't hold every stock for 3 years. If people have to understand that it is a portfolio which adjusts. IIFs do adjust to the requirements of where we see returns. I mean, returns are what drives our investment philosophy, investment strategy. So we don't sit with model portfolios and hope for things to happen.
Do you let macro events sort of define any decisions that you take tactical decisions in the short term based on any macro factors?
It does, but we are not a macro-based, data-based investor. We are more bottom-up. But we need to be cognizant of what is happening at the macro level, but not get bogged down by it. That's it. So we do, like I said, we do understand, and when we do realize that there are macro events, so obviously we do tactical calls. I like shifting more to pharma or something like that. We try and do that, but broadly, or if we see there's a broad-based slowdown happening in consumption, we reduce our investment consumption and move more to industrials and things. We take that kind of tactical calls, but we really don't get bogged down by macro.
Okay. And taking that to the fact of abhi kya lagta hai? What do you see? What's your outlook for the next 3 months, 6 months?
So the thing is that Trump, everybody keeps talking about what's happening to Trump, and that's actually peaked out. The whole Trump drama is peaked out. It will keep happening for the next 3 months until people get tired of it, or maybe he signs deals with Europe and Japan and Korea, and people will get tired of it, and that will happen. The thing is that whether there's going to be a recession in US, that's obviously the key. We don't know. We don't think it will happen because Trump is also aware that his popularity is sinking and he needs to keep that economy afloat. So I don't think that will happen. As far as India is concerned, and we are more concerned with what's happening in India, this year would have been a good year, but for all these things which happened, the geopolitical events and things like that, especially that we don't have elections, except the Bihar election comes later, it would have been actually a good year. But it has not happened so far. The credit growth, consumption and all that has not really taken off the way we expected it to. But now that with these tax changes which have happened, we think that some of that will start to revive in the coming months. We are positioned towards domestic recovery in our fund. Mostly it is domestic based, except for pharma, of course, which are more bottom up kind of investments we have made in pharma. Other than that, we are heavily domestic based, and that's why we think that India as a country, as a market, will continue to remain expensive as long as these themes continue to attract interest from investors.
Great. So let me change gears a little bit. What is a typical day in your life today, and what was it, say, when you were in your previous role or early in your career? Do they look substantially different?
Yeah, no, it's not different. Of course, I was younger, so I could do a lot more, many things. But I'm extremely light. Since '87, I've been actually investing in stocks, investing or taking part of interest in stocks. I started my job in '87. So from '87, I worked till 2015, and now I'm 25. So 2025. So I worked for whatever. I mean, you can calculate 13 plus 25, 38 years. I've actually been active mostly in stocks, mostly. Even there was a small period where I was working for a bank I was interested. I could not really do much on stocks, but I was interested in stocks. So I basically have that's my most of the day I spend in terms of evaluating, looking at stocks, reading balance sheets, reading company reports, reading research reports, discussing. So that's what I typically do. And obviously, I have other hobbies which mostly are travel related. So I like traveling and things like that. And now I'm too old to start playing sports and all that. I don't do too much of that. I do yoga and walking and some bit of swimming. So other than that, I don't do much.
Okay, great. So, what in your previous role, it was Merrill Lynch before you started Ampersand, right?
Yeah,
Yeah. So,
yeah.
what was that moment or that day or that week where you decided that no, I need to do this on my own now?
Oh, no, no, there wasn't a day or a moment. It was days and days. It was months and months. I was tired. I was extremely tired. My body couldn't take it doing taking that high pressure job just because it is giving you high pressured money. So I just didn't want to do it. And afterwards, my just body caved in the sense mentally I could not do it. And that is why I kind of decided. So see, I didn't start when I left in April 2015. April 29th to be precise, 2015, I started only in August. And in fact, I would have waited for maybe 6 more months because Rahul lost his job in Standard Chartered and he said he wants to do something. So he joined me in August. So that is when we started the investment advisory. Otherwise, I probably would have just waited for a year and a half, and then thought of launching a fund or whatever. So there, yeah.
Okay, great. So, before signing off, any book recommendations that you would
Sorry,
want?
I am very bad at this, my books and all that. My colleague Sanjay keeps on giving me books and he says, you must read this, you must read this. So I read a couple of them. I don't, but I'm not an avid reader of business books.
Yes,
I
could be
don't,
anything else also.
I don't. So I just read random non-fiction, whatever. But it's not something which is my forte of trying to recommend anybody. So it is. I hardly get time to read, get out of this whole market psyche and spend time on reading books or watching art. Thankfully, now you don't have to go to cinema halls to watch movies. You can sit at home and do that. So that saves time. But yeah, so I'm not the one who can actually give you great books. I know a lot of these pundits who come on CNBC, they say they've done this and all that. It probably adds to the resume and people get excited by it. But I don't want to fool people by saying that I do the same.
Speaking of pundits, so during your long career, any sort of investment gurus that you followed early on?
See, I was close to Rakesh Jhunjhunwala.
Okay.
I was actually close to him. But a lot of things which he did, one has to realize that it could not be inhuman. One could not do what he did. So one thing which I liked about him is that the ability to take risks, believe in it and take risks.
Great. Thank you so much, Arun. Thanks for your
Yeah.
time.
Thank you. Yeah. Thank you, Shri.
Lovely meeting you. Lovely speaking to you.
Absolutely.